While the crypto market has been obsessing over the Federal Reserve, Jerome Powell, and the next interest rate pivot, a much bigger storm is quietly forming on the other side of the world. A storm that history suggests could send Bitcoin down by 20% or more in a matter of days. We are potentially staring at a $4 trillion global liquidity shock. But unlike the Fed, this central bank is not preparing to print money. They are preparing to drain it. And the date you need to pay attention to is December 19th. That is when the Bank of Japan makes its next policy decision. And if the last few times are anything to go by, you do not want to be positioned on the wrong side of this move. So the question is simple. Is this the catalyst that sends Bitcoin back towards $60,000? Or is this the ultimate bear trap before the next major leg higher? Today we are diving deep into the yen carry trade unwind, separating fear from facts, and figuring out what this actually means for Bitcoin and the wider crypto market. Before we begin, a quick disclaimer. This is not financial advice. This is purely educational content designed to help you understand why your portfolio may be far more connected to Tokyo than you ever realized. Now let's start with the basics. What exactly is the yen carry trade? It sounds complex, but the concept is surprisingly simple. Imagine you could borrow money at almost 0% interest. Then you take that money, convert it into another currency, and invest it in assets that yield 4, 5, or even 10%. That is essentially free money. For decades, this is exactly what institutional investors, hedge funds, and global banks have been doing with the Japanese yen. Japan kept interest rates near zero, and sometimes even negative, for years in order to fight deflation and stimulate economic growth. So investors borrowed massive amounts of cheap yen, converted it into dollars, and poured that money into higher-yielding assets. US tech stocks, US treasuries, emerging market bonds, and yes, Bitcoin. Estimates on the size of this trade vary widely. Conservative estimates place direct exposure somewhere between $1 and $2 trillion. But once you include derivatives, leverage, and off-balance sheet exposure, some analysts believe the total yen-funded complex could be worth $4 trillion or more. And this system works beautifully, until it doesn't, because the entire trade depends on one thing staying true: cheap money. And that era in Japan is coming to an end. Which brings us to the key catalyst. On December 19th, the Bank of Japan is widely expected to raise interest rates again. According to surveys, essentially every major economist expects a hike. Prediction markets are pricing in probabilities north of 90%. The BOJ is expected to raise rates from 0.5% to around 0.75%. Now, on the surface, that sounds insignificant. Compared to US rates above 3%, it seems tiny. But in leveraged markets, the rate of change matters far more than the absolute number. And the historical data here is brutal. In March of 2024, the Bank of Japan raised rates. Bitcoin dropped roughly 23% shortly after. In July of 2024, another hike followed. Bitcoin fell more than 25%. And then came the August crash, when Bitcoin wicked down toward $50,000 in a matter of days. Each time Japan tightened liquidity, crypto felt the pain. So why does this keep happening? It all comes down to currency dynamics and forced selling. When Japanese interest rates rise, the yen strengthens against the US dollar. And when the yen strengthens, investors who borrowed yen suddenly owe more money in dollar terms. That triggers margin calls. And when margin calls happen, investors don't sell what they want to sell. They sell what they can sell. Bitcoin trades 24 hours a day. It is deeply liquid. And it is easy to offload quickly. So it often becomes the first asset sold to cover losses elsewhere. This creates a liquidity drain, pulling capital out of risk assets and sending it back to Japan. But that is only part of the problem. Japan is also the largest foreign holder of US government debt, owning more than $1 trillion in US treasuries. If Japanese domestic yields rise, investors who have been funding the US government for years may decide to repatriate that capital. If they sell treasuries, US yields rise. And when yields rise, risk assets like tech stocks and crypto get hit even harder. That is the double whammy scenario. Now, before we jump to worst-case conclusions, there is an important counterforce at play. While Japan is tightening, the United States is quietly easing. The Federal Reserve may not be calling it quantitative easing, but it is effectively injecting liquidity back into the system. Through balance sheet stabilization and treasury bill purchases, the Fed is adding roughly $40 billion per month to keep financial plumbing functioning. This sets up a global liquidity tug-of-war. Japan pulling money out, the US pushing money in. And Bitcoin historically loves liquidity. So which force wins? That depends on positioning. Unlike previous Bank of Japan hikes, this event is not a surprise. Markets are already pricing it in. Traders are already hedging. Short positions on the yen are elevated. This reduces the chance of a complete blindside shock. That said, volatility is still highly likely. So let's talk price levels. On-chain data shows a significant support zone between $80,000 and $84,000. This area aligns with short-term holder cost basis and heavy ETF inflows. If Bitcoin holds that level, the move could end up being a brief shakeout. But if 80,000 fails, things could escalate quickly. In a full panic scenario, similar to August 2024, Bitcoin could wick down into the $60,000 to $70,000 range. That would represent maximum fear. However, there is an important long-term anchor. Bitcoin has historically not traded below its electrical production cost for extended periods. That cost currently sits around $71,000. If price approaches that zone, long-term buyers tend to step in aggressively. So what is the strategy? First, avoid high leverage. Volatility around this event could be extreme. 10% down and 15% up in the same day would not be surprising. Excessive leverage will wipe you out. Second, watch the USD-JPY pair closely. If the yen begins strengthening rapidly, especially below the 148 or 145 levels, that is your early warning signal that the carry trade is unwinding. And third, keep dry powder. If we do see a sharp liquidity-driven flush, recognize it for what it is. Not a broken thesis, not the end of crypto, but a mechanical unwind in global markets. The Bitcoin halving has already occurred. Institutions are here. ETF demand remains strong. And global liquidity trends remain favorable over the medium to long term. Japan may cause turbulence, but turbulence is not the same as collapse. So the verdict is this. Expect volatility around December 18th and 19th. Expect sharp moves, fast reactions, and algorithm-driven wicks. But unless something truly unexpected happens, any dip driven by Japan's tightening could ultimately prove to be an opportunity for patient, disciplined investors rather than a signal that the Bitcoin thesis is broken. Liquidity-driven sell-offs tend to be fast, emotional, and often temporary. And historically, those moments of peak uncertainty are where long-term positioning is quietly built. That said, markets are rarely that simple. So now I want to hear from you. Do you believe the yen carry trade unwind is the black swan event that finally cracks the market and triggers a deeper correction across crypto and risk assets? Or do you think this move has already been fully priced in, with traders prepared and downside limited? Are we looking at a genuine macro shock, or just another short-term liquidity scare that ends up shaking out weak hands before the next major move higher? Drop your thoughts in the comments below. I read them, and they often shape the topics we cover next. And if you want a deeper understanding of how global liquidity, central bank policy, and macro forces actually drive Bitcoin's long-term price action, make sure to check out the next video on your screen right now. As always, thank you for watching, thank you for your support, and I'll see you in the next one.